So I get a lot of phone calls every day, and the question is, Dan, what's today's 30-year fixed rate? There is none. And I'll explain that when we come back, so don't go away. So what's the main question you have when you're getting a mortgage? What interest rate am I going to get? That's number one. The one big flaw there is you got to make sure you check out the costs. What we're going to talk about today is the rate. So if you call somebody and the first thing you say to them is, Mr. Loan Officer or Mrs. Loan Officer, what's your rate today on your 30-year fixed? And they spill out a number to you, please hang up. And the reason being is they don't have a clue what they're doing. Here's what I mean by that. How interest rates on your mortgage get calculated. There's three main components. And if you're a broker, there would be four main components if you're using a broker. Component one, let's say that's A, is the cost of funds. How much does it cost me to get the money to lend to you? Okay, so that's component A. Component B is what we call loan level price adjustments, and those are the biggest factors involved when it comes to mortgage rates. And then component C is the profit margin that we as a lender want to make. So let's dig in on A, B, and C. A, the cost of funds is normally pretty standard throughout the different lenders that you're going to call. But the bigger entities with better credit ratings and so forth probably are going to have a little bit lower rate, but where they might make it up is on their profit margin, and we're going to get there in a second. So let's say, for example, your cost of funds or my cost of funds is 2%. Then the next component is loan level price adjustments, and this is where mostly nobody has a clue out there what these adjustments are unless you're in the business. So let's go over those adjustments. Adjustment number one is based on your credit score and what we call your loan to value. Okay, so the higher your credit score, the better your rate, okay? Loan to value, here's what I mean by loan to value. It's the loan amount divided by the value of the property. The higher that loan to value, the higher your rate. Okay, so that's component number one with loan level price adjustments. The next is, what kind of property is it? Is it your primary home? Is it a second home? Is it an investment property? Is it a single family, a condo, a 2-unit, a 3-unit, or a 4-unit? That is another loan level price adjustment. And as you can see on the screen, you can see what those adjustments are based on each little piece of the puzzle. And then component number three is, are you looking to purchase a property? Do what we call a rate and term, which means you're just refinancing the balance that you owe currently. Or are you looking to cash out? Meaning pull cash out to pay off bills, buy a car, buy an investment property, invest, or remodel your basement. So that's the final loan level price adjustment. And then there's profit margins. There's companies that want to make a ton of money and do a little amount of loans, and there's companies that want to do a ton of loans and a low profit margin. That depends on the individual investor. So now we take components A, B, and C, which again, A is cost of funds, B is your loan level price adjustments, and C, your profit margin. You add up all that, and that's your mortgage rate. So you can see every scenario is a little bit different. What is your credit score? Yours is different than your neighbor's. What kind of property is it? Is it, your neighbor might have a condo, you might have a townhouse, you might have a 4-flat. That plays a role. Are you looking to buy that property, or are you looking to cash out? All of these factors get involved, okay? So now the fourth component, if you're working with a broker, now the broker's fees has to be added in as a D component. So now you have A, B, C, and D equals mortgage rate. So you can see the more pieces of the puzzle that you add to this equation, the higher the rate. So that's explaining the loan level price adjustments, and that's explaining how mortgage rates are created. So to find out what you qualify for, I need you to call us. I need you to email us. So God bless, guys. I hope you find value in my channel. Please give me a thumbs up, subscribe down below, hit the bell so every time I post a video, you get an alert. Have a great day. Hope to hear from you soon.